Joining us now is Paul Schutz. He's the Executive Director and Client Portfolio Manager at JP Morgan Asset Management. He specializes in European equities. Paul, so good to see you. And I know you're based in London, so you're here on a special visit.
Correct.
I want to start off by asking you the question, of course. Mario Monti has said that this Euro crisis is almost over. That's a direct
quote. We put our feet up and relax, can't we now? Yeah.
I really think we should examine their vacation schedules to actually see if that's actually the truth, right? Because if more of them are taking vacations, then it probably is a better indicator versus his comments that he said. What do you think? Is this almost over?
I mean, obviously he's in a reasonable position to actually be able to understand the exact time frame of things. I think one needs to consider we are in a period of deleveraging. Deleveraging of sovereigns, of the banking system, consumer within many countries as well. Deleveraging typically takes close to 10 years, so whether or not we're truly at the end is difficult to tell, or whether or not this scenario is going to work out at a shorter time frame than the norm is very difficult for us to know. The important thing, obviously, for investors is it's all about rates of change, and sentiment is obviously increasingly important. We've seen that this morning with some numbers focusing on last night's numbers from the US rather than this morning's numbers from Japan. So I think when we look at Europe, you need to really be considering where are we versus expectations.
Yeah, Paul, I mean, it's something quite intangible quite often, and it might be just the mood in your office. Has that changed in the last 2 or 3 months with the dark days of December, for instance?
Yeah, are you guys taking vacation?
I would say this from a corporate perspective, in the sense of what we do is all bottom-up focused, and actually things have remained relatively robust. I mean, corporate balance sheets are in an incredibly strong position. There's a great deal of valuation dispersion in the market.
It doesn't actually correspond to the fundamentals of the economy because of, I guess, international exposure for some of these companies.
That's right. I mean, Europe is probably one of the most exposed regions to overseas. Approximately 50% of European corporate revenues come through from outside of Europe. Emerging markets makes up approximately a third of that. So when you look at European equities, you're really looking at what is your play on global demand and in particular emerging market demand rather than just what's going on within the Euroland region itself.
What I want to know is how fearful are you of contagion risk? I mean, what really stops Spain from saying, I want to do exactly what Greece did. They restructure their debt, sign me up for that, and let's count Portugal in and all these other countries that are suffering as well, because really there's nothing stopping them from saying, you did it for Greece, do it for us.
That's correct. But remember, Greece has had to go through and jump an awful lot of hoops, or go through a lot of hoops, should I say, in order to actually get to this point. I think it's in no one's interest for Spain to do that, and Spain in particular would realise that it's not going to be of any benefit to them to actually go through that scenario.
Many analysts actually think that these hoops you just referred to are probably inevitable. They're in the future for Spain and Ireland and Portugal.
Well, it's certainly true, but if you look at the Irish, they've actually taken a very different approach to the Greek in the sense that they started through their own measures in order to actually cut back expenditure themselves. They've adopted many policies in order to try to get their economy onto the correct footing, and their current account is showing that in the sense that they're trading through at a surplus rather than deficit, which is important. I think a lot of other countries in Europe are taking that lead rather than the Greek role.
Paul, you're here, okay, so, China, of course, is a story, and we talk about a slowdown. Do you see any evidence of that coming through on the corporate balance sheets you look at, and how does that actually impact what's going on Europe-wide?
Yeah, I mean, certainly it's going to have an impact, there's no doubt about it. Obviously, different sectors are going to be impacted in different ways. The mining industry, particularly if you look in the UK stock market, obviously a lot of miners are listed through there. That obviously has implications through if there's going to be commodity demand from China, then obviously that has knock-on implications going through. However, you're still seeing relatively robust demand coming through from China and other emerging markets for some of the more luxury good items or more specialist items, whether or not you're looking at autos, whether you're looking through at consumer durable types of goods, whether you go into some of the industrial sectors. Some of the technology from Europe is needed in other parts of the world, and slightly slower growth isn't going to affect that.
Well, okay, as you do specialise in Europe, we're talking about the relationship that we have, of course, with China. How does that change the way that you advise your clients?
I mean, I think when we're talking to clients, we're obviously doing very much from looking at the opportunity sets within the European space. And it's more a question of how we position our portfolios. Obviously, people want to know about, from a top-down perspective, what are the wider implications and how does China fit into things. But for us, it's more a question of looking at what does this mean for the future valuations for companies, for the earnings of companies. Does it mean management are going to have to change their policies and maybe their capital expenditure plans if they're no longer seeing the growth rates that they were once seeing? So we'll take it from that angle.
Yeah, as we were saying before the break, you were mentioning that corporate balance sheets are very strong, and we talked about because of the international exposure there. So tell us a bit about how you actually do position yourself. I mean, is it about those, as opposed to looking at indigenous growth within Europe, because you're not getting much?
Yeah, I mean, certainly. I think it's almost sort of safe to say you'd probably never invest into European equities if you're purely looking to invest based upon the relationship with the European economy. The advantage you've got is then there's some very good charts that are out there in the marketplace that actually show that there is virtually no correlation at all between economic growth and equity returns that actually come through. So for us, fortunately, when you look, you find that Europe tends to perform very well, particularly when there's increasing and growing global demand. It is a strong play on that sort of global demand from a developed market perspective. So if you believe that things are sort of continually going to remain robust, which sure you might see slightly slower growth for China, maybe it comes down from 9% towards 8%, maybe slightly lower, who knows. But that's still very robust demand versus what you'd see from the European economy itself.
And the returns we've been getting so far this year have been pretty good, and of course this is down partly to more liquidity in the system because of the LTRO program instituted by Mr. Draghi. Now, we had the second lot of that, and of course these things have a bit of a time lag before they make themselves felt. Yeah. Do we get another bump up in equities as a result of LTRO 2?
Well, I think LTR is all about sentiment as much as anything, in the sense of what it did to remove some of the fears from many investors, particularly around the banking sector. Well, whether that ultimately feeds through into the underlying economies and through into other companies from banks being able to lend out more is obviously yet to be seen. You've seen in certain countries the bonds benefiting from sort of banks buying into sort of those longer dated bonds and bringing sort of the yields sort of around because of that. So I think when you start to sort of look through, you're starting to see a steepening in the curve because people's assumptions are there is going to be improved economic growth going through there, and therefore as a result you can see opportunities certainly at the stock level. As a result of that, there's been this risk on trade, more cyclical sectors performing very strongly, robustly, and from a valuation perspective we can identify a lot of those.
Paul, thank you so much for joining us. Paul Schutz from JP Morgan Asset Management.